The most important aspect of being a successful real estate investor is probably deal analysis, but it doesn't have to be difficult. Welcome to Financial Fluence. In this video, I'll teach you how to calculate rental property returns using Metric Matrix. Let's now get going. Most metrics and calculations required for deal analysis are actually quite simple. They involve operations similar to those found in middle school, such as multiplication and division. However, many metrics and acronyms such as cash-on-cash return, return on investment, cap rate, and internal rate of return can be confusing. People have a tendency to become fixated on a single metric that they have come to understand and used exclusively for investment. If you want to be a good or exceptional investor, you must truly understand all of the available metrics. At first, you cannot use only one metric, because each piece of common real estate investing data serves a specific purpose and enables you to answer a critical question. Each statistic helps answer one of the many questions that investors have to ask themselves all the time. Failure to learn which metrics apply to which situations, on the other hand, leaves you flying blind, which can lead to uninformed and sometimes bad decisions. So knowing your numbers is the key to being a confident investor, especially in this confusing economic climate. So all you need to know is how to analyze deals like a pro, which may sound difficult, but isn't, and which metrics to use when evaluating your next deal. Simply put, many investors calculate metrics without considering the question at hand. Perhaps they've heard of a cash-on-cash return and want to make a comparison. But do you actually get a cash-on-cash return? And what distinguishes it from other metrics available to real estate investors? As a result, the first step in selecting the appropriate metric is to consider the question you're attempting to answer. What if I asked you, what percentage of my initial investment will this deal return? Both are straightforward questions, but they are not interchangeable. How much will I profit from this investment is an excellent question. These two issues cannot be addressed using the same metric. There are several things that will affect how much of my initial investment I will get back each year. If you want to account for compounding or the time value of money in your returns, you'll need a lot more knowledge and new tools. There is no ideal or perfect metric, no right or wrong measure. Rather, it depends on the questions you're attempting to answer. As a result, you must first consider the questions you want to address in your next transaction or throughout your deal analysis. Here's an example. Consider purchasing or wishing to purchase a standard buy and hold rental property. One of the first questions you'll have is, how much money will this make me in a year? It's a simple question, and you should definitely use cash flow to find the answer. You can find the cash flow formula right here. Rent income less expenses equals cash flow, which is a simple calculation requiring only addition and subtraction. How much money will this generate is the question you want answered. This is a simple calculation. This is just one example of a buy and hold rental. If we were investing in a multifamily or syndication, we would most likely approach the same problem with a different metric called net operating income. Rather than cash flow or noise, profit would be used to estimate how much money you would make flipping houses. One or more of these indicators may be used to answer the question, how much money does this investment make every year, depending on the circumstances? To expand on this example, imagine you realize that not all buy and hold transactions are solely about cash flow, and that there are other benefits to investing in real estate, such as appreciation, amortization, and tax benefits. If you sell your home today, you may be wondering how much of your initial investment you will receive. You keep the property for a while and reap all of these benefits. But cash flow cannot quantify this, because we need to know how much the property's value increased and how much of the loan was paid off. Instead, a new metric is needed, and the simplest is the return on investment, or ROI. And before we continue, don't forget to subscribe to the channel. Hit the like button and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. The majority of people have heard this phrase, but if you don't know how to calculate it, I'll show you. In essence, you divide the purchase price by the amount you paid after deducting the sale proceeds. Let's say you put $200,000 into the project and sold it for $300,000 in a few years, giving you a 50% return on investment. If you want to calculate it, you can, but a 50% ROI is a very respectable result. As a result, the situation remains unchanged, but this time I have a different question. I'm more concerned with the ROI of my initial investment than with how much money I'll make each year, ROI. The situation is the same, but the question is different, necessitating the use of a different metric. Is it better, for example, to own a transaction for 3 years and receive a 40% return versus 7 years and receive an 80% return? We need a different metric to answer this question. To compare agreements with different hold times, you must be able to calculate ROI, but only by year. The annualized ROI is determined by multiplying the ROI by the length of ownership. Your ROI varies by an average of 13% annually if you divide 40 by 3, or annualized ROI. We divide 80 by 7 to obtain a return on investment of 11.4% for deal 2. With this indicator, it is now possible to figure out which contract brings in the most money each year. Transaction number 1 is crucial since it gave us a better total return as well as a higher annual income. However, you are unsure which offer provides the best financial value. You can see that deal 1 is better per year, and there is no right or wrong answer here. But now that you're asking more good questions, you're gathering more information to make an informed investment decision. Finally, suppose you paid $100,000 for a new deal and received $2,000 in cash flow per year, and you invested another $75,000 in capital improvements, but did not do so until year 5 when you sold it for $300,000 and 1031 exchanged it. What's the ROI? Your cash inputs and outputs are both numerous. As a result, a more sophisticated metric, the internal rate of return, must be used. This is an excellent measurement to learn because any investor must understand the concept of the time value of money and the effects of compounding. However, if you're flipping a house, you might not need something super complicated. And if you're just buying a turnkey property, you might not need IRR, which isn't as sophisticated. But if you're doing a BRRR deal, IRR is a great metric to use to compare different deals. These examples should demonstrate that there is no single correct answer. Rather, the key is to identify the questions you want to answer and then use the appropriate formula to simplify the process. You should now understand when some of the metrics we discussed today can be useful to investors. Think about using profit and loss, cash flow, return on investment, and equity multiples as needed. As previously stated, we also have an internal rate of return, a cash-on-cash return, an average annual return, and a compound annual growth rate. You can use it whenever you want while looking at transactions and studying them to determine which metrics are best for the questions you're attempting to answer. However, it is critical to avoid becoming overly reliant on and connected to a single metric. Unfortunately, investing is more complex than that, but when done correctly, the measures can be calculated fairly easily. The fundamental concepts underlying transaction analysis are, in fact, universal and simple to grasp. Whether you're working on a large construction project, a single-family rental, or a home hack, all you need to know is how to perform this incredibly simple math. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.